that speech, maybe have the leader of opposition make a case for the opening up.
Hey, I'm audible, right?
Yep, you are.
Starting in a second. All right, starting in 3, 2, 1. We are completely fine with defending quantitative easing and a higher amount of spending by the government in order to boost the economy. I think the trade-off in this debate is whether or not we want to risk inflation or we want to instantly give more people and businesses the opportunities to revive the economy, which we think is vitally necessary. First, before I talk about why this is specifically necessary in the context of England, let's talk about why inflation is not as bad. I want to firstly point out that the case is not entirely unique. That is to say, reducing interest rate is not only the only factor, nor the major factor through which inflation persists in those countries. That is to say, there are other factors, for example, England being intertwined with other economies that are currently struggling with inflation, for example, the USA that has 10% inflation, and with other countries within the European Union, that is also a factor that increases inflation. But secondly, inflation, guys, money is kind of fake. The way in which we perceive money is based on our own subjective perception. At the point at which we live in a society that has medias that excessively negatively portray the coverage of the situation within the country, and people think that the economy is not going to be getting better, or people generally have some biases that make them irrational to think that the prices will keep on rising. This means that there are other factors that keep inflation regardless of whether or not the government is pursuing those policies. But secondly, I just wish to point out, when we're talking about specifically about England, they have 5% inflation. This is not huge, and it's not as huge compared to other countries. For example, the USA that has 10 or 11%. So I know BP is about analysis, but factually speaking, England is not that ravaged by inflation to begin with. But thirdly, even if we presume inflation is a huge problem at the moment, we think that there are mitigatory mechanisms through which we can deal with inflation. Because the case of Puljić is basically that prices are going to be rising, and vulnerable people within society, for example, workers, will not be able to keep up with that. We have a few responses to that. The first of which is that legislation within many countries within the European Union, including the UK, exists so that the wage you are receiving is readjusted for inflation. Secondly, we think there has been a massive rise of labor movements within the UK, USA, and the European Union in general through COVID, of people basically boosting solidarity and going against corporations and showing a huge amount of social pressure in order to ensure that they can have livable wages. So we think even if inflation exists, it is not that bad. Now, on to constructive. I just wanted to first point out and to frame this debate, because our policy is dependent on people having a trust in the government and willing to spend at the point at which we have more governmental investment. I think this is likely to be the case because, firstly, we want to characterize what is going on in England at the moment. They're facing some economical struggles because they were going through COVID. They have had some hard relationships with the EU, and they're still readjusting their deals, which means they need a boost to the economy in order to be more economically prosperous. But notice that, secondly, we have trust in the government at the point at which this is basically a policy that is going to be accompanied by is basically accompanied by other policies that are giving financial incentives to act. I think that, secondly, specifically people now in England feel as though the pandemic is going to an end. That is to say, the rates of people dying and the rates of infections are actually lowering, and England has taken active steps to show that they're actively recovering societally and economically. They just opened their borders. But we think that, thirdly, companies which make the most major investments and are mostly reliant on this convenient financial opportunities by the government are likely to be investing at the point at which they can closely collaborate with local or national governments in order to ensure that they get convenient rates. Now, comparatively, we think this is better because the side of OG is basically firstly undermining the legitimacy of the government and thus the willingness of the people to engage within the economy and to engage with the government in order to cooperate at the point in which they're changing the course that they have been having for the past few months. That is to say, they're basically reversing the policy that they have. Secondly, comparatively on their side, they're basically fucking up businesses because businesses have gotten used to the current economical climate that was dependent on them relying on lower interest rates and more governmental spending, which means they have to be readjusting their plans. And thirdly, I know this is short-termistically, but basically changing the course of your policy is is kind of problematic at the point in which you have to make readjustments within governmental institutions in order to accommodate for those new economical policies. And also you have to have more discussions with your close collaborations with corporations that are living domestically, which means this is hugely problematic because it creates a short-term problem in which you don't have a cohesive and clear economical policy, which is deeply problematic in times of economical struggle. Now, on to constructive. Why spending money on the economy at the point in which inflation is not a guarantee and it's not uniquely caused by this something that is good? We think that firstly, it is good because it allows people to be spending more. That is to say, it allows people to be taking credits at lower rates, and it allows more credits for people, which means people can be spending in the economy. This is not only something that is individually valuable at the point at which people are likely to be rationally spending on things, for example, like computers and courses that are convenient for them in their own self-realization, but secondly, because it basically boosts domestic businesses and the economy because the money trickles down to other businesses and so on and so forth. I think that secondly, this is especially beneficial for businesses, which are more likely to be taking loans at the point in which they have lower interest rates. And also this is especially beneficial because we have, at the point at which the government is spending more, we have a higher capacity to lend to more businesses, which is hugely beneficial at the point at which we live in a social and economical climate in which many businesses were ravaged and they desperately need the finances in order to continue to exist. So I think this is all very beneficial for that. Before I continue, I'll take a point from closing.
The average person doesn't care about monetary policy. They care about more proximate perceptions. So if you say that people think COVID is coming to an end, don't you think that encourages spending in and of itself?
Yeah, and we're saying that this is one more. Okay, this may encourage spending. That is to say, it gives them the incentive to do so. But this policy in specific, that is to say, quantitative easing, actually gives them the capacity to spend because it is more convenient for them. And secondly, it gives the capacity to spend in order to realize that incentive for more people at the point at which more governmental spending is likely to lead to more people having the capacity to spend. Now, the third mechanism is pretty intuitive, quantitative easing, the policy that we're more likely to defend at the point in which we don't want to reverse that, has to do with the governmental buying bonds. That is to say, buying bonds from governmental institutions or buying bonds in order to, in the short term, protect financial institutions and other corporations that live domestically in England, which means it frees up cash, that is to say, capital, which they can invest in further operations, which is hugely beneficial because it allows even more opportunities for companies to be investing within the economy. And generally speaking, within companies are likely to be investing in the economy at the point at which, firstly, we already framed that people were thinking that the economical recession is ending, but secondly, corporations and companies in general, they're not only competitive, but they're insanely competitive and wish to become at the top at the point in which other companies have been ravaged, especially after an economical recession, and it's a lucrative opportunity for them to develop themselves. So I think this is impactful, firstly, because it improves the general well-being of people because it gives them more financial opportunities that they desperately need in an economical climate that was very uncertain until recently, but it basically boosts the economy, which is generally that is very good at the point in which economical benefits have a tendency to trickle down to people. That is to say, more money or more job opportunities, which have not only financial financial goods, but also social benefits. So I think for all those reasons, I'm just very proud to oppose.
We now have the Deputy Leader of the Opposition to close off top half debate.
Hi, I presume I'm audible.
Yep.
Great. POIs in the chat. I'll take one from closing at 5, and I'll begin in just a second. Okay, so starting in 3, 2, 1. Government themselves say inflation is bad because people cannot afford basic necessities, but then go on to show that people won't be able to afford those things because they can't take loans, because they don't have a job, because businesses don't have money, and they have to spend higher prices on products because there's less production because businesses have to pay more. And this, to me, seems a bit contradictory, right? Because the burden that they want to take on themselves is, oh, people live better because they're can afford the basic necessities, but actively contradict this by their actions. Let's look at what they necessarily say in terms of constructive. One, they say, again, contesting whether or not England is in very bad inflation situation. I want to contest this on 2 grounds. One, we believe that just as we already proved, this will is a short-term problem. Why? Because again, England is a big economy. It's likely that you would not drive itself down to death because of inflation. But even if it does, I think there are two ways that it doesn't do it. One, when prices are rising, this becomes the new normal, right? Not only because many countries are within the situation, Europe, both the Balkans, but also more so England themselves. So when prices rises, this means that this is the new normal. How people adjust is by having government spending that allows people to adjust to this, right? Having wages that are not worse, a lower amount because of because you don't spend enough money in governments, or because people cannot afford stuff because they cannot take loans. It means that the inflation will likely not be such a big problem as they paint it to be. But secondly, if you did this, I think they do not necessarily prove why those specific policies are extremely effective in fixing the inflation, right? Because note, even if you do this, you are dependent on other countries who are not likely going to fix this in the similar way, right? Now they say, but England is not as dependent on the EU and stuff like this, but they are. They still have the similar trading agreements and stuff like this. So if Europe doesn't change, they won't be able to change as well. So the point here is that there is a marginal benefit or even a lower probability that this is likely going to work to the huge burden that they take on themselves. What we compare this to is either one, if people trust the government, because CG are correct, people don't understand fucking politics, they don't understand how monetary policies work. What they want to see is that the government is able to provide for them. They want to see that people they're able to live their normal lives, and they want to see, for example, they have a job, or that their kids don't don't pay that much money because prices are increasing. I think this is more important just on the basis of probability, but I'm going to further this on later in the debate. Second thing they say is, we increase people's savings, but I think this is kind of absurd to say. It's not as important as they make it say. One, note that while people take loans, it's because they don't have savings. Not many people can afford to have savings. Not many people have a surplus amount of money that they can set aside and be able to take. Two, note that during those times, banks don't allow people to take out their savings that much, which means people are actively deprived of having the ability to do so. What I think is more important and more intuitive is that, yes, okay, maybe some people have a bit more money in their savings account, but most people take out loans because they don't have the money. So if they have a greater ability to do so, on our side, when you have lower interest rates and when they're able to get their life back on track and adjust to the new normal, as it is said, we believe this is a net benefit. Because no, the period in which you're able, they will concede that they will harm people, because again, they have to supposedly, right, they want less spending and they want people to have less money and not be able to afford stuff because they want to limit the spending, which means that you actively harm people in a very bad way. That necessarily means they live worse lives on the comparative, but I'm going to move on to that later. Secondly, though, they say investment. And I think this is a bit weird to run, in the sense that investment in and of itself, if every country is in this situation, I'm not sure why everybody invests on their side of the house. I'm not sure what the counterfactual necessarily is if you're able to fix this too. I think that a lot of businesses care for the economy being good. This means people being able to spend more, because businesses rely on people spending. So if people are not spending, businesses don't care if you're a good economic investment or not. Two, we believe that generally businesses want your economy to be in place, which means if you are not able to do so, and if businesses are not providing, or if there are shortages, or just generally people cannot afford to buy your product, they wouldn't even care. So they have to provide the counter, alternative to this in order to be able to work. Compared to our analysis, though, all they do is debate in a vacuum. They say, but our policy will fix this, not engaging in any of our analysis to why necessarily being able to have more people spend on this actively makes this better in the long run, even if you have to concede that some things will be bad in the future. But before I continue, I would like to take closing.
Things like structural unemployment, minimum wage laws being politically charged, etc., means that wages rise slower than prices rise, which is the predication of your case, which is to say people don't get the money to spend when prices begin to rise.
But again, you have the loans, even if presumably wages are lower. I think governments are likely going to have to incentives to increase this, because if people are not able to afford this, it's either backlash for them, they look illegitimate, or that they are not able to look with the situation. This specifically works in the context where they went through Brexit and people are questioning if this was a good economic decision, which means that they will have to do this. Now, moving on to further on this, even if we have to concede that prices will rise slower, I don't think this is fair, because even if products rise, this means that, for example, the business that you work in have to let you go because they cannot afford to hire you anymore, because they cannot take a loan, because they cannot let themselves be in the market. I think this is pretty intuitive in terms of it's better to have maybe a not as high of a job, but have any job at the purpose. Now, moving on to the last thing I want to point out, which is compared to everything that our case presents. Basically, I think in the specific context where people are questioning again if Brexit was a great idea and generally want to just live greater lives, because the point of this was to make domestic basically industries better and to be more independent. The problem here is what people see is that they are not granted the loan, even though the country says you're fine, which means people start to question if the situation is actually good. This means that the point at which they question it, it's harder for you to fix any market failure in terms of that. So if you want this to happen, it's like that you need people to trust the system and to trust the process, because the moment that they're not granted the loan, they start to question it, even if you don't understand monetary policy. Secondly, note again, OG themselves concede people cannot afford basic necessities. Even if you presume that inflation will, to a certain extent, exist, they do not necessarily provide how much harmful this is to compared to like people not being able to afford rent and being homeless, or like they cannot afford to let their kid have the specific medical treatment that it needs, and they may be harmed in the long run. Not going to the extremes, but they die. But you know the analysis. So the point here is, we prefer to be able to save people short term, considering all of our analysis to why inflation will likely be solved, not only in the short term, but also even if it's not, it's like not as bad as they paint it to be. But what you necessarily have is, they don't always provide the solution, right? This is probable, it's not always for sure. But what you do for sure grant is people having worse lives because they cannot afford stuff, having no jobs because business cannot afford to pay them, or like businesses not investing in certain projects that people need, such as providing enough products so there won't be any shortages and stuff like this. We believe this is immensely more important because it's one, just a lower burden to presume. They take this huge burden that they're not able to present on themselves, and we believe that we are able to do this better. Secondly, even if they do fulfill the burden, we believe that on the short-term, long-term comparison that we make, it's likely that in the long run you harm people better if they don't spend right now, such as they will make detrimental changes currently that will like deprive them of abilities right now. If you are like, you lose your apartment now, you'll not be able to change this. We're very proud to oppose.
I send the speaker for that speech. Maybe now have a member of Gov to kick off the back half debate.
Am I audible?
Yep.
Cool. Okay. I'll be starting my speech in 3, 2, 1. Let's first mechanize why inflation will stay high and continue to rise. If we prove it's not a short-term phenomenon, we prove that OP is structurally unsustainable. There are numerous reasons for this. First of all is Brexit, the isolation of the UK from the European Union free trade area and regulatory umbrella, which creates economic instability. No, this is still an ongoing legislative process with a number of unpredictable points in it, which is to say that insofar as it's unclear what direction the economy will go, the confidence in the pound drops, therefore devaluing the pound and rising inflation. Secondly, ongoing geopolitical crises. Saudi Arabia unpredictably manipulating the supply of oil to leverage against other exporters such as Russia or Venezuela, but also a potential Russian invasion of the Ukraine and unpredictabilities regarding the Nord Stream plan, which makes it unclear to what extent gas and oil will be exported or not exported. Of course, the UK has some supplies in the Dogger Bank and similar areas, but these are very exhaustible, which is why they're currently very invested in helping the US diplomatically resolve the Russian crisis. Thirdly, COVID-19 effect, supply chain disruptions, which raise shipping costs, meaning companies need to make up for that cost by rising prices. But secondly, regardless of whether the pandemic realistically ends or not, there's private sector risk aversion. There have been numerous variants. After we were told the vaccine would end the pandemic after the Alpha variant, we had Delta and Omicron, which means numerous times restrictions were reimposed, which means that prices rise to make up for that unpredictability. But fourthly, note that people think differently to companies, and this is the POI give to opening opposition. People perceive the end of the pandemic, which is to say that clubs are currently packed in the UK, that there is an increase in consumer spending, which means that the pound floods the economy. Therefore, the people themselves are raising the inflation and raising the prices for themselves without being aware of that. The problem is also this can become a self-fulfilling prophecy so far as it can lead to a surge in cases and new mutations. Now, we've already had a Freedom Day in the UK and then reimposed restrictions after that. The consequence of this is that inflation is likely to remain and rise long-term, which is to say that even if O is correct that it's not bad today, it's going to rise in the future. The recovery opening opposition wants to see doesn't happen if purchasing power is low and people do not have a disposable income to spend on that recovery to have the money circulating through the economy. So even if in the short term we have a lower injection of money, here is the comparative. The spending will happen anyway because people have a proximity bias. People see an opportunity cost towards what they've missed. At the point where things are reopening, people can go out again. They want to do all of the leisurely activities and spend their disposable income on things that are not staples, even if this is not necessarily a rational decision. This is why they're currently spending like crazy. But also the economy opening up also creates a new investment climate, which is to say investors want to have the first mover advantage when the economy opens up. So we do get an element of recovery and we do get a trickle of money through the economy. The question is whether the single unit of currency is going to be valuable enough to sustain that recovery, which is to say to sustain the late stage pandemic recovery, we need to be able to sustain the value of money that we are likely to get anyway. However, if we continue to go down the inflationary pressures, the money is likely to go to go badly, which is to say that we need a countervailing measure to this, given all of the mechanisms I've given you as to why inflation is likely to be a long-term phenomenon, therefore over time rise and become unsustainable because people cannot spend, which is to say we've mechanized opening government as to why inflation is long-term and proven why op is unsustainable. The thing opening opposition says here is, oh, but we can have government spending to make up for prices rising. First of all, you would need wages to rise faster than prices rise. This is unlikely because first of all, structural unemployment means that employers can always leverage lower wages by saying, if you don't take this job, somebody else will. Secondly, there's a fear of unemployment, which is to say when you raise the minimum wage, companies make up by firing workers. A fear of unemployment triggering political backlash means that you will not raise the minimum wage, but minimum wage debates are also very politically charged. It's hard to maintain a coalition and raise the minimum wage very high. That's perceived as a left-wing and socialist policy, meaning prices rise quicker than wages rise. The only response then left from all is, but they can take loans. But you do realize it evens out because more loans means that prices rise, so you don't get a larger amount of disposable income. The only comparative is, insofar as inflation is long-term, we need a policy to combat that inflation and sustain the recovery that happens anyway to make it meaningful. Let's talk more about how this policy looks like, because it's not just about increasing interest rates and not just about financial impalpable assets, which in part will answer the closing opposition POI. It's also the government selling assets using the Bank of England as a mediator in order to reduce the amount of money in the economy. The status quo is that the government holds onto numbers of assets such as land as a store of value, but very often the government doesn't efficiently invest in these assets because it doesn't have the resources nor the time to do so. The comparative is that these assets are going to be sold off, i.e., for example, land is sold off to the private sector that can then use this to build high-rise housing, for example, which can then lead to a higher supply of housing, reducing rents, but also a higher supply of housing that increases the revenue from rents long-term, which means you get more money circulating in the economy. But secondly, note that quantitative easing as a policy started in 2008 with only short breaks because of COVID, which means that the government currently holds a large amount of assets with money bound up in those assets, which means currently that what the central bank can do, because it holds on to these assets, is it can use this money to act as an investment bank towards the government. It can pump this money into investments such as hospitals, such as infrastructure, which don't increase inflation, but are efficient for economic recovery. So this can be used as a policy for the central bank to raise the amount of money that it has in its reserves to stimulate the same type of recovery that opposition wants, but without having these assets also increase the amount of money in the economy and therefore increase inflation. Thirdly, though, let's provide more context to the idea of imports and why they're incredibly important, right? Because opening government just says imports are not going to be cheaper. Why does this matter? Because the UK is a net importer from the European Union. They have just lost access to the European Union free trade area, which means a sudden rise in costs for consumer prices. This goes hand in hand with the current political situation between the EU and the UK. Before I explain why that matters, I'm going to take opening opposition.
If inflation is so horrible, then why would this policy be uniquely effective in counteracting that when you yourself claim that people just really don't care and the cops are packed, so they are not going to be impacted by this policy?
Well, your policy is not effective. Ours is, because it doesn't involve a large amount of money being pumped into the economy, which increases inflationary pressures regardless of whether people care about monetary policy or not. What is the importance of the context of the UK and the EU? The context is that we have a likely tariff war happening. The European Union wants to make an example out of the United Kingdom. They want to ward off countries like Hungary and Poland from leaving. So they want to make the situation in the UK worse. The UK is likely to respond, first of all, for political reasons, but secondly, because hardline Tories are probably going to push Boris to respond. Boris currently already has his chair shaking because of the party gets scandal, etc. He will have to placate people like hardline Tories, which is to say that you're likely going to see a rise in import prices. The UK is dependent on the EU for manufactured goods such as cars, but also because ease of shipping from the EU means that shipping costs are lower. It's easiest to import from the EU, which means there's captive demand in the UK. Therefore, the recovery that opposition wants is dependent on importing from the European Union, which is why it matters to raise the strength of the pound, to increase your importing power. This mechanism OG, but responds to the recovery point from OO as well. The last thing we want to say is that opposition doesn't have any proof as to why when people take out low interest loans, they're going to spend them. If you take out a low interest loan, your interest is to hold on to the money, because the risk of holding on to the money is low because the interest rate is low. So what you get is people thrifting on the money taken out of the banks. It's not being spent, but it hurts banks' liquidity because more money is issued out and not being spent. Banks don't have the money to issue the additional loans that opening opposition wants because people act in thrift, not in spending, which is to say opposition doesn't have a case in either world. Closing government has won this debate.
I thank the speaker for that speech. May we have the member proposition make a case for the closing up.
Hey, am I audible?
Yep, audible and visible.
Setting timer.
Okay. Starting in 3, 2, 1. 2 cases in my speech. First, I'm going to talk about why it also fucks over our ability to do fiscal policy and wait over the top half. Secondly, I'm going to talk about why this is a temporary problem that we are doing a not temporary and almost irreversible solution to, engaging quite strongly with CG. But before that, 2 pieces of framing and some pieces of engagement with CG separately. One piece of framing that is important. I want to note how the unique reasons given for why we have an issue of inflation, mostly by OG, but I'll go to CG soon as well, are not really solved under the motion. I.e., if the main reasons we are experiencing a spike in inflation now are because of the recent COVID crisis and rise of oil prices as a result of this, we are not going to change this, right? Oil prices continue going up. The only thing we are doing is slowing down the rest of the British economy in a way that doesn't add up to the rise in oil prices. This is worse than inflation. This is stagflation. This means that we are creating an economy that is weaker and less growing and allows for less salary growth to match the rise in oil prices. And everything that OG describes just gets worse under the motion. So problem-solution mismatch. Second point of framing, which I think is important. The status quo isn't never changing our policies regarding quantitative easing. The status quo is waiting. And this is important towards both governments. The Bank of England doesn't always stagnantly remain with the same policies with regards to quantitative easing and use of currency. However, it is currently very conservative and waiting for signals. This inflation is, by the way, very, very recent, which is why it didn't act until now. It is waiting to see the results. This means under the best case of government, even if they manage to prove that somehow this inflation is unique and not temporary, which we think they didn't, but we'll get to that, they need to show why we need to act now, why the central bank can't act in a few months in the future once they see it is longer. Cool. With that being said, few responses to CG, which we'll also get to some of the case, why we think the inflation is incredibly temporary. First, and that's important, boom and bust cycles in general tend to be temporary. I'll start with an intuition pump and then I'll explain it. Intuition pump, think of your own currencies when you try to buy things from abroad with USD or euros or whatever. They somewhat fluctuate, but in very rare cases, extremely rare cases, a la Venezuela, there is hyperinflation. Most other cases, the currency exchange rate remains roughly at the similar level. Why is that? Quite simple. When a currency is losing value and becoming cheaper, it also becomes cheaper to buy and import from this country in their currency, because now it's cheaper for me to buy in GBP than USD or vice versa, because the currency lost its value. As a result, more people buy this currency, which, hey, guess what happens in its turn? Pushes its value back up. This is why most inflation cycles are temporary in their nature. We didn't get any analysis to understand why uniquely there is a reaction here that would not balance itself in this case. And noting, Brexit didn't do this. Factually, the first thing that happened after Brexit was the pound immediately increased in value, and it decreased later on when COVID started. The reason for this is, as much as people like comparing currency to lower is always the result of what happens when people lose faith in the economy, that's not how currency works. Losing faith and instability in the economy, like Tim mentions, only creates fluctuation. It can lead to devaluing or to pushing up of the value of the currency. For example, if investors believe that it is likely now that the UK is going to export less and therefore the value of the currency might go up. Cool. Let's talk about fiscal policy. 3 crucial reasons why we think we're losing our fiscal power in this motion. First, less quantitative easing, which CG already conceded means more government debt, but I will actually explain slowly as well for people who don't understand what quantitative easing just by the jargon of it. Less quantitative easing means we buy less government bonds that we then depreciate in value. This means that the value of the government bonds is now increased. Government bonds, I will remind you, is a signal of debt. It means that when we don't depreciate their value via quantitative easing, our debt gets higher. Secondly, it means there's also less investment, because when the interest rate is higher, there is more of an incentive to save and less of an incentive to spend. So this leads to less GDP growth, therefore less taxation, and again, smaller budget. Thirdly, it also leads to a signaling effect that you stop doing quantitative easing and that you increase the interest rate, which leads to doubt of investors that in the future you can pay back the debt because now it's increasing and you have lower budget. All of this leads to a chain reaction of even a smaller budget. Before I get to the impacts of this, OG, go.
Still not sure what your comparative is. If it's just wait in the bushes, this nice OO who says you need to push spending now. If it's wait and implement later, then you accrue all the harms now. If inflation is temporary,
okay, thank you. You got one POI. Thank you. Our comparative is literally the status quo because this is how analysis motions work. Cool. Impacts. Two big things on that. First, it means that we cannot use alternative solutions for solving the problems that government described, which are better. Note, and this also answers your POI, under our side, we can use fiscal policy to help do things such as subsidize specifically oil prices if this is the thing that is concretely expensive, as opposed to generally depreciating the economy without solving the problem of oil crisis. It means we can give specifically subsidies to poor people as opposed to regressively to spreading it around to all the economy, because this is how currency works. You cannot target it. Okay, quickly on irreversibility. Push because you are not reason why the central bank is waiting. It is extremely hard to say you'll do A, but in a span of month do B, and without seeming extremely uncredible to investors, especially when you need to act a lot against the wishes of the government that don't want you to lower quantitative easing because it diminishes their budget. So you need to get so much capital that you cannot back up on. So we are creating solutions that we are committed to for a few years for a problem of a few months. Beg you to oppose.
I thank the speaker for that speech. May we have the Gov Whip to summarize the case for CG?
Cool. Audible, yeah?
Yep.
Cool. Sorry if I start coughing this speech. I'm just after recovering from COVID, and speaking a lot has now brought back the cough, but we'll see. Starting off with closing opposition, I think the first thing to say with regards to their fiscal policy analysis is that it fails to deal with the sophistication of our analysis, where we explain to you that the removal of quantitative easing as a policy means that the government gets more money that can invest in specific things. So for example, when we explained to you that post 2008, the government bought up a huge amount of property, which is now extraordinarily valuable because property prices were at an all-time low at the time, but the population only ever increases in London and in, Birmingham and those kinds of places. This specifically therefore means that this is a medium through which the British government, using the central bank as a medium, can generate a huge amount of money to invest in specific infrastructure and projects to deal with these kinds of things. So even if in their best case, they have, an increased political ability to do things like investing in subsidization of oil, we can do that on our side of the house, because when we're able to do things like decreasing the monetary supply in the rest of the economy, we can invest in specific targeted sectors to try and combat the sources of inflation in the first place better on our side of the house. I also think the signaling effect analysis here there necessarily falls to our analysis. When we explain to you that we're able to invest more in broader infrastructural projects, it makes Britain a better target for foreign direct investment, which therefore is a positive signal for the economy and incentivizes corollary investment in that specific domain as a way to, interact with the economy as it develops outside of the thing. I also don't see what the specific benefit of is waiting, insofar as we've explained to you how this policy is likely to skyrocket. I'll deal with their responses to that case now. They say that there is a cause-effect discrepancy insofar as we don't directly deal with the cause of inflation. I've already responded to how we have an increased capacity to do so on our side of the house, but also dealing with the core premise here. It's unclear to me why, if inflation is a bad thing and it's caused by a certain thing, if we can mitigate the harm of that thing, that is not an a priori good in and of itself. I also think we explained to you how economic growth can happen on our side of the house in a much better way. Insofar as the way the economy is structured on their side of the house is oftentimes people holding onto money in contingency funds, as Tin explains to you at the end of his extension, because when interest rates are low, you loan out money to hold onto it for a rainy day, whereas if interest rates are high, you're more likely to spend that in the economy insofar as you get it. We also get better exogenous investment, as I've explained, but also we liberate the working class for reasons I'll explain in more detail later. But insofar as on our side of the house you have lower housing prices and better government infrastructure and public infrastructure, this means that this policy hurts the upper class in terms of their money available to them, but not the working class. So we get a better diversification of the economy, which is a positive signal for investment, but is also an indicator of economic growth in a better way, because economic growth is not an a priori good, it's a good when it hits the people who need it the most. Dealing then with the rest of the debate. In terms of inflation and why it's happening, OG just say the word COVID. I don't think the average informed voter knows why a disease causes inflation, which leaves them weak to the CEO response that this is a time-sensitive issue, implying the policy would not be necessary. We fill in this gap by explaining a number of things. Firstly, actually explaining the energy market and actually explaining how COVID interacts with these kinds of economies. Thirdly, with regards to geopolitics. Fourthly, with regards to private sector risk aversion. And fifthly, with regards to people misunderstanding because of cognitive and psychological biases how the economy functions, leading to incorrect investment, which leads to long-term inflation. I think opening opposition to this say, well, other countries are inflating too. But the problem here is that as we explain when we further mechanize the opening government claim as to why imports are of a specific necessity to the United Kingdom, as to why we need to be competitive in that import market. So even if everyone is increasing their rates of inflation, we want our currency to be lower than those in order to actually stimulate the economy and prevent economic collapse. The second thing to say here is that other countries are, for the reasons outlined in this debate, implementing these kinds of policies to mitigate these effects. And if Britain is slow to react to the trends that we've outlined here, they will no longer be able to compete in these markets. So broadly speaking, their responses to this don't make a lot of intuitive sense. Moving on then to the problems of inflation and why inflation is a specifically important thing that we need to deal with in these instances. Say people need loans to afford things, but noting firstly, the UK already has quite a high standard of living. Secondly, for the reasons we've outlined, wages rise slower than prices, so inflation prevents them from having the amount of money necessary in the first place. We would prefer them to just have money without having to pay interest on it in the long term, which can oftentimes fuck up families insofar as they get leveraged with lots and lots of debt they can't pay back, which also leads to shocks when that happens more often in the economy. On our side of the house, they just have more power for their wages in the first place, which is preferable. Thirdly, quantitative easing of property also means assets like houses become cheaper, but also fourthly, and this is a response to their case, insofar as housing prices go up because of inflation, because if housing prices are at a particular level, the value of your currency is going down. It means you can no longer, your wages don't pay your rent as much as they used to, and so consequently the price of housing would be worse on their side of the house, so we have more people with more money. But also noting here, you have more long-term savings on our side of the house, so way up versus future people. And also sixthly, knowing that their policy seems to specifically affect upper class people in a more better way. The conclusion of this argument then is the cost shifts to be levied against the wealthy people in the country who use things like private investment, who use private infrastructure like schools and hospitals and taxis as opposed to public versions of those infrastructures, which we can invest in more on our side of the house because it doesn't lead to inflation, and who have things like housing and property already tied up so the housing market doesn't affect them in the same way, and who invest in things like art which don't actually stimulate the economy. The conclusion of this argument is that this is a specifically effective policy in a way that is able to A, prevent the worst excesses of inflation, but also lead to more sustainable economic growth in the long term in a way that opposition never really properly deal with. Before I move on to some other things, I'll take opposition.
Okay, so your whole argument is about dealing with the domestic economy by specific investments, but your whole frame that Tim started his speech with is about inflation being long-term because of external factors.
Yes, the way in which you interact with external factors is by domestic things, because the Britain, as far as I know, can't control the domestic policy in the United States. But what they can do is, as your closing say, specific targeted investments in those kinds of sectors that we can get by liberating funds that the British government has available to them, by liquidating assets that they already have, while preventing that liquidation of assets from having a terminal effect on the inflation of the economy by tightening the monetary supply in other areas. This POI doesn't deal with the sophistication of our analysis. I think therefore, we also explained the specific necessity of imports vis-a-vis opening government when we explained that specifically with interactions in the EU and the heightening of tensions across that border, we're likely to need these kinds of imports to have long-term sustainability in the future. With regards to quantitative easing, bonds are only one form of the ways in which they can happen, but they've become increasingly unpopular as a way of doing this. What's more likely is things like NAMA in Ireland and the British government doing these kinds of things, where notably the British Crown owns a huge amount of assets because they used to own the entire country, are able to sell off that land to liberate money for themselves, but also liberate the housing market and other kinds of property markets via private investment in housing, that kind of thing, meaning a decreased decreased cost of living for the working class in the country. We have specific benefits to the working class in those areas, so we're able to maintain economic growth for those who need it the most, and we're able to prevent inflation's long-term negative effects from ever accruing, and consequently win this debate.
I thank the speaker for that speech. May we now have the opposition whip to end this debate as a whole.
Hello. Am I audible?
Yep, audible and visible.
Huge. Gosh. All right. Starting off in 3, 2, 1. I'm going to be honest, I do this for my degree, and even considering that there was so much competing claims, competing assertions, and lies in this debate that it's become incredibly messy and hard to consider. Given that, then, I'm just going to talk about 2 different cases that occur in this debate. Firstly, if inflation doesn't persist, and secondly, if inflation does, and why we win on both these accounts. Before that, though, I want to do a few notes. Firstly, I want to note on the burdens in this debate. The burden in this debate is proving why this sort of contractionary monetary policy needs to happen right now rather than in the future. So all of the things that come from closing government about import prices, etc., going up and that potentially being bad are not in this debate, insofar as the currency can always appreciate in the aftermath of things like COVID or in 2 to 3 periods, and they never prove why it needs to happen now. That is not something that needs to be considered in this debate. The second thing I would note, and this is on their thing about land prices, this is just patently absurd, right? The UK engaged in a policy of austerity and so on, and balancing the government budgets in the period between 2010 and around 2015. So if it was the case that the government had this many assets to sell, they would have done that already in order to balance their books. It's also just factually wrong. I don't know where this lie has come from. All right. Now I'm going to talk about what happens if this inflation case is not actually persistent. Because I want to note here that opening government are right. The United Kingdom has structural weaknesses in its economy in the form of things like structural unemployment and in the form of anemic productivity growth and all of these sorts of things. That's why the 2010s was considered a lost decade. But trivially, if that's true, what that proves is that inflation and this inflationary shock is temporary, because things like structural unemployment actually decrease inflation, because it means that less people have spending power, because it means that actually the cost of labor decreases because more people are unemployed. So those are all the reasons that prove why inflation is not a long-term phenomenon and only occurs as a reason of cost push shocks relating to things like energy prices. So actually the long-term fundamentals of the economy are weak and will likely result in a depressing of output in the long term. I would note this, it just is true that this is because of an energy price shock. So, if truth is worth anything in debating, then we're kind of winning here. The reasons we get as to why this is persistent from TRIN are essentially Brexit, COVID, and Ukraine. All of this is wrong. Brexit happened in 2016. If that would have caused inflation, it would have been visible prior to COVID, but obviously it didn't. Everything they say about COVID as well, there's increasing adaptation towards the harms that have existed as a result of COVID, and also Omicron is demonstrably less strong than other previous variants, so the solution is happening there. The other thing to talk about is Ukraine, and yes, this might lead to a specific rise in energy prices, but that can be offset in the way Hadar suggests through things like energy caps, and indeed that's what the UK government has ended up supporting. This is then where we enter this debate, because really what Hadar shows is that the UK fundamentally is likely to need things like QE and expansionary monetary policy, partly because this enables fiscal policy and enables things such as, for instance, combating the energy crisis and so on. I would note that this analysis, which wasn't particularly responded to by that previous speaker, also is logically prior to opening opposition, because all of opening opposition's benefits, all of the things they say about, for instance, you having money to spend and so on, is contingent upon proving that under comparative fiscal policy wouldn't step in. We prove why fiscal policy can't step in, because the only reason why fiscal policy occurs is because of QE and the central bank buying these bonds, which then enable the government to borrow more and thus spend. Given that this is impossible now, and given that the government is also relatively conservative when Rishi Sunak wants to balance the budget and so on, fiscal policy on the comparatives are unlikely to step in. So we fill in that analytical link. We prove that there's the only way to ensure people continue to get money is in the form of this QE, and therefore we take it over them. Before I continue to talk about the case where this inflation is persistent, I'm going to take a POI from opening. No? All right. I'm just going to keep talking. Okay, let's suppose then that this inflation is persistent. Let's say that we buy all of these weird reasons coming from government about how this is actually super long term and it won't be solved, it won't go away in the future. Given that then, I think that we want to solve this problem significantly later than we do right now. Why is this the case? Because if the central bank engages in this now, it's essentially irreversible. There are a few mechanisms Hadar gives here. Signaling, the idea that once central bank commits, it needs to follow through. The idea that essentially if the central bank does this, that means that government borrowing is less likely, so it's taking a massive political risk, and so it will need to follow through on that. But also the thing I'd add here is if there's a first mover disadvantage. Dylan said in his previous speech that other groups are considering raising their interest rates. This is not true. The Federal Reserve has just said it might consider raising interest rates in future periods. The European Central Bank has made no indication of doing this. I mean, that's just empirical fact. But if you want reasons to why other countries are incredibly hesitant, it's because central bankers are incredibly risk averse. People like Lagarde and the people who lead these central banks have made a career out of things like expansionary monetary policy, and so they're incredibly unwilling to do it. They also have really bad experience, right? Because it's something called a taper tantrum, where in 2013, the Federal Reserve tried to raise interest rates, but then that caused an economic downturn. So really what that means is that central banks are incredibly reluctant to engage in contractionary monetary policy. So what that means is that when the Bank of England does this, it will be the first mover who does this sorts of policy. And what that means then is that the private sector necessarily expects them to commit to it, because central bank is essentially pinning its mast on saying, you know what, we are going to cut these interest rates and so on. And so they're essentially forced to continue to do it in the long term. And I would note, given that then the private sector is going to be incredibly skeptical of the central banks doing this, insofar as they see that other economies are not engaging in contractionary monetary policy to the same extent. I would note then, but that if this policy happened in the future, it would be a lot easier for central banks. Why is this the case? Because then it can act when other countries are also raising their interest rates, and so go in line with the general consensus, which is obviously what central banks prefer, because it seems much more normal and rational by the private sector. And also because it can then raise interest rates to a much greater extent, and the signal is more credible in that sense. The only reason we get from government teams as to why it needs to act now rather than 2 or 3 periods of time if inflation remains high is essentially this idea that if inflation stays high now, that leads to some sort of harm. But I would note that the harm is very easily reversible insofar as you can then restrict inflation in the longer term and to prevent that from occurring. And whereas you have to weigh that very reversible harm to the irreversible harm we get of a potential tipping into a recession at the point at which central banks engage in this policy and so lead to output contracting and fiscal policy being unable to work in the way that Hadar suggests. Look, at the end of this debate, I want to be very clear. In real life, the central bank has not raised interest rates yet because it's waiting and watching to see if this inflation is and only then will it act. No matter how many competitions Tin has won, I think that I would much rather trust their judgment than what any single person on Gov thinks. And I think that insofar as central bank hasn't raised interest rates, we probably ought to trust them on that. Very proud to stand in closing opposition.
All right. Thank you for that speech. That also effectively ends this particular debate. And now I would request all teams to leave the panel B.